Welcome everybody to People Power Social Club. We've been going for 8 weeks now. This is week 9. And welcome to Kevin Chuah, who's a former fund manager, and he's here to talk to us about how investors can promote sustainability.
Really happy to be speaking to you here from the US. Quick background on myself. As Anna mentioned, I'm a former fund manager. I was in the industry for 13 years, which feels a long time ago now, and felt like a long time. Most recently, I was actually working at BlackRock, which is, you may know, is the largest asset manager in the world. I left the industry 4 years ago to start my PhD at London Business School. I'm here visiting at Wharton at the University of Pennsylvania for this academic year. I'm also a research fellow at Share Action, which is a UK-based shareholder activist charity that you might have heard of. And to spoil the story that I'm going to tell, this is basically an advert for Share Action. So I'm being completely shameless in plugging them, but what I think they do some really great work, and hopefully I can inform you a bit about that as well. But when you think about the investment industry, you probably think of people like this. So you probably think of asset managers and hedge funds, and that these are the powerful, mainly white men who have all this capital under their control, are buying and selling stock in these companies, and then are demanding these companies to basically try to bolster profits. Now, that's not completely fair, because when you look at firms like my old firm BlackRock, you might know of the CEO Larry Fink there. He has been starting to try to get firms to act a bit more responsibly, in terms of first of all making sure that they are looking after investors' interests. But there is a bit of a narrative now in terms of sustainability. So they have been trying to increase the number of people within their organization who focus on sustainability issues. But generally, I'm quite a critic of BlackRock, and we'll get to some of that shortly. But I just want to present a slightly balanced version. In terms of hedge funds, you know, people have called them locusts and the like. To be fair to them, though, and you know, I spent most of my asset management industry in the hedge fund industry. To be fair to them, they are agitators, and often too many investors don't agitate firms to do something. Now, the question is, do they agitate for good? And I'm very much questioning that, and there isn't too much evidence to show that from a sustainability perspective that they do much that's positive. So that's how these large investors have tended to influence firms. They use their large holdings in these companies to try to demand for more profitability effectively. But then what about sustainability issues? And this is really the focus of my PhD research. And interestingly, you're seeing investor coalitions becoming more prominent. So on the left-hand side here, you've got a group called the Interfaith Center on Corporate Responsibility. Now, this is a US-based coalition of mainly religious investors. So the woman actually in the middle there is a Catholic nun. Her name's Sister Patricia Daly. Now, this group use what's called a shareholder resolution. So in the US, if you own $2,000 of a company stock, you can actually get a statement or a question to be voted on at each company's annual general meeting. And so they're one of the most prolific users of this device to try to get questions about environmental reporting, wage concerns or labor concerns at companies, and also other supply chain type issues. And so they've brought together other investors, including asset managers and state pension funds in particular. So there is some movement on that side, and this group has been at the forefront of that. And then on the right-hand side, there's Share Action, based in the UK. And to some extent, they're like a UK version of ICCR, except that they're not trying to really co-opt asset managers and other investors. What they're trying to do is to get grassroots involved, and then for the grassroots to pressure those other investors and firms in particular. And the photo that I've got there is my favorite picture of shareholder activism, which is actually when Sainsbury announced that they were going to use a fairly traded label instead of fair trade, the official fair trade mark for their tea. You've got a bunch of share action people, but also other NGOs as well, dressing up as tea bags, walking into the annual general meeting of Sainsbury. And I think they were asking questions about this for the best part of an hour, to the point where the CEO said, "Okay, no more questions on fair trade." But that's the sort of grassroots campaigning that can be done. And again, just to provide some balance in terms of for the asset managers, there is some movement from mainstream investors to consider sustainability issues. So in 2006, the UN, along with about 40 other large investors, mainly Dutch pension funds, Nordic pension funds, and a couple of motivated asset managers from the US and Europe, set up the principles for responsible investment. And this is really where that whole environmental, social, and governance, or ESG mentality started becoming popularized. And so the whole idea of this is that mainstream investors needed to recognize that they need to start considering these ESG issues as part of investment issues. That not only are they these separate things, but they're integral to what should be done. So that movement has really grown now. So roughly 2,500 member organizations. So basically every large fund manager you can think of now, including the likes of BlackRock, Fidelity, Legal & General, Schroders, and the like, are members of this. And in aggregate, we're talking about $90 trillion of assets. That's basically, if I'm not mistaken, 1 year's worth of world GDP. The problem is that with an organization such as this, there's a lot of hangers-on, a lot of free riders. And so the question is, who's actually doing the engagement work to work with the targeted firms to actually change their behaviors? Who's actually encouraging those? And the big problem, which I'm glad is getting more attention now, is that the large asset managers aren't doing enough. So there was a big spread in The Guardian earlier this year, which really focused on the big three. So Vanguard, BlackRock, and State Street. And between them, for the vast majority of the world's biggest 1,000 companies, they'll own at least a 10% stake. In some cases, they're owning 30 and 40% of those companies. Now, the problem is also that because a large part of what these asset managers do is so not doing much in terms of engaging with those industries to encourage them to become more sustainable. If you think of the big oil producers, so in Europe, you've got Shell and BP. In the US, you've got Exxon and Chevron and the like. There's very little dissent going on there. And that's obviously very frustrating. And some research by Share Action looks at the voting of these asset managers on issues relating to sustainability. So, as I mentioned before, each year, if you're a shareholder in a firm and you meet certain criteria, you can put one of these resolutions or questions to the board of directors, and you can actually get all that
Anyone else
had.
drop out a little bit, or is it just me?
Oh, sorry.
Yeah.
Yeah, me too.
Oh, sorry. Did I drop out?
Yeah.
Yeah.
Oh, sorry. What, do you remember where I just stopped?
You just said that people could put a question forward.
Oh, sure. Yeah. So as I mentioned before, in terms of the shareholder resolutions, you can actually formally ask all the other shareholders to vote on your question or on your issue. And in fact, one that Share Action coordinated recently was at the Barclays annual general meeting. So around 120 of us put together a resolution to Barclays, asking them to commit to basically the Paris climate goals, and to change the way that they lend to fossil fuel firms, so that their loan portfolio doesn't contribute to climate change, or contributes less to climate change. We got about 25% support for that, which actually for these sorts of things is pretty huge. But what we're looking at in here is that we're showing that many asset managers, many large US asset managers, tend not to support these sorts of things, right? So we actually had support from Legal & General in the UK. I think we also had support from AXA as well. But BlackRock, Vanguard, State Street, JP Morgan, they all voted against it. And between them, they own about 10% of Barclays. So it is very frustrating that these investors aren't being mobilized. And so then the natural question becomes, well, why is that the case? Is it that these asset managers just don't care? Well, actually, I think it's a bit more, potentially more insidious than that. And so when you look at some of the academic work, these fund managers tend to have business ties with the firms they target. So for example, I don't think it's a secret that Exxon's pension fund and Shell's pension fund actually invest in BlackRock funds. So you have this whole set of conflicts of interests potentially there that really aren't spoken about. And so part of my research is also to try to shed more light on that, and really to highlight how these conflicts of interest mean that investors aren't pressuring firms they invest in because they're worried they could be clients of them as well. Now, the problem for you and I is that if you've got a pension, if you've got savings in a mutual fund or in an investment trust, this is our money, right? And we're giving this money to fund managers who are in many ways conflicted. And I don't want to throw the baby out with the bathwater. There are obviously some asset managers who have done a good job, and some of those on the previous slide, including the likes of Schroders, Aviva, Legal & General in the UK, of the larger ones, have actually done pretty well on this and continue to improve. But then other reasons for why this is the case. Well, if you look at the board of directors of these large asset managers, so here I've just taken BlackRock's board of directors and JP Morgan's board of directors. What is interesting is that when you actually look at the companies that these board members come from, you'll notice something quite interesting, that these are all firms that these asset managers also invest in. So if you look at JP Morgan on the bottom right there, I find it, I'd find it very surprising if JP Morgan were to pressure Exxon on how they operate in terms of sustainability and moving towards green energy. Similarly, I'd be very surprised if BlackRock were to criticize RBC, the Royal Bank of Canada, for how they're funding and financing operations in the tar sands. in Canada, which is another big source of very dirty fossil fuels. Not only in terms of the fossil fuels themselves, but the way that tar sands production occurs. So again, you've got conflicts of interest there in terms of the governance of these large asset managers. So the question then becomes, well, what can we as savers and pension holders do about this? And this is my big plug for Share Action. So if you have a Twitter feed or all your social feeds, they're on there. They do produce some interesting stuff. It's not all doom and gloom. But what they do every now and again is encourage individuals like you and me to speak up to our pension funds. So if you have any pension savings, or even if you just have some sort of investment in with a managed fund, you can get in touch with those asset managers and pension providers and actually ask them, well, what are you doing? Why aren't you voting for our resolution against Barclays? What are you doing to try to actually encourage these firms to be more sustainable? And even though it is you are pressing up against a very big force, actually not many people get in touch with these pension funds and asset managers on these sorts of things. So I've spoken to, when I was an asset manager, not once did any of my investors bring up this sort of thing. When I've gotten in touch with asset managers and pension funds before, some of them have said to me, "You're the only person who's raised this question." So it just takes a couple of people to ask, and then hopefully that starts changing how they're thinking. So we're really trying to mobilize on that. Another thing that Share Action does is it encourages and facilitates people to go to the annual general meetings of these large firms. So I mentioned the one before in terms of Sainsbury. Shell has been one that we've been going to a lot. I went to Cineworld a couple of years ago where I was asking about the living wage. And so the range of issues is quite broad, and it goes from the social to the environmental. And basically, you dress up. I put a suit and tie on. I go to the meeting. There's only 20 other people there. Most of them work for the company, and you get to ask a question direct to the CEO or the chairperson. They're very respectful of the questions. They'll give a decent answer, and then afterwards you can actually have a chat with them. And I had an argument, a very polite argument, I should say, with the CEO of Cineworld for 10 minutes after the meeting, and I said, and we're talking about the challenges that they face in terms of committing to a real living wage, but also putting it across our side, our perspective of why paying a living wage would be beneficial for them, but also especially for their employees. And this hasn't completely gone away in the virtual world. In fact, last month I was on the virtual AGM of Coca-Cola and also Kellogg's over here. So I got to speak directly to the CEO and ask them questions about what they're doing in terms of the sugar content in their foods. So anyone on this video conference can actually volunteer and become part of this. Something to keep in mind probably for next year, because it really ramps up from February and March, and the main AGM season is actually right now. And then the last thing that I'm suggesting is you can engage on social media. And so you can see this tweet on the left here, BlackRock talking about sustainable investing. Great. One of the responses actually was from the Sunrise Movement, basically subtweeting and saying, well, what are you actually doing in reality rather than just talking about these sorts of things? Why are you still funding fossil fuels? Okay, you don't have to be as aggressive as that. But around the time that Sainsbury were switching from fair trade, I was engaged. I was going directly to them, asking them, "Why are you doing this?" And it was interesting seeing how many tweets were about that as well. But also in terms of other asset managers, there's been lots of targeting, especially of the larger asset managers, in terms of their inaction, or to encourage them around, particularly around important votes. So I'll leave it there. I hope that was an interesting or somewhat informative breeze through of shareholder activism, what isn't being done and what is being done and what you can do. I hope it's a good advert for Share Action. I hope it's motivating in some way. If it's not something that you can take part in, if you know anyone who is vaguely interested in this, then please send them our way. We'd be more than happy to have them on board. So yeah, thanks a lot. And I'll turn it over to questions.
Thank you, Kevin. Should we do like a virtual round of applause? Sign language for clapping. So does anyone have any questions first before I ask my one? Malky does.
Just to clarify, yes. So if I've understood correctly, for example, ICCR are they invest in companies not for generating profit, but merely to get access to ask questions at the table, and Share Action are primarily just promoting getting questions to people high up. But we have a different structure in the UK, so you don't have to have shares in order to do that. Is that correct?
I'll probably mischaracterize them to some extent in those respects. So ICCR tends to be investors that already have capital invested in these firms. So for example, for those nuns, their pensions will already hold most of the S&P 500, so the largest firms. So that already provides them with access to those companies. For Share Action, they actually do something which I think is really smart. They buy one share in each firm. And if you have one share in each of these firms, you can turn up to the annual general meeting.
Kevin, I've done exactly that with Brewdog, because they have a big festival drink up. So that's why I have one share in Brewdog.
Exactly. That's right. So you can turn up to that, and you know how that is. You can then talk to people in that firm as well and ask them how they do things. You're making me miss Brewdog. They don't sell it over here. But then what Share Action also do is that so that provides them the opportunity to go to these annual general meetings, and then from that they try to get a meeting with management to then encourage managers to do something about that. But then on their research side, they do a lot of ranking of asset managers. So that's what I was showing you before. And through that ranking, asset managers actually engage with them to say, what do we need to do to look better on this? Because they recognize that it's a reputational risk for them. I find unfortunate that it is that reputational angle that they're generally most focused on, rather than we want to learn to become more sustainable. But hopefully, as more sustainability oriented people join these firms, that actually changes.
So the ranking system you're talking about, is that available on the Share Action website for anyone who has pensions and is wondering what their money is going towards? That's
right. So actually, every 2 years they do a formal ranking, and the results of the latest round have just come out. So they actually look at the largest pension providers. So it's called the Asset Owners Disclosure Project, AODP. But you'll be able to find that on their website. And that actually ranks all the asset managers. They also do other rankings as well. So they rank banks in terms of their lending practices.
We've lost you.
Oh, sorry.
Yeah. Oh, you're back.
They do other ranks. Yeah, they do other rankings as well. So they have also published a ranking of banks' lending portfolios, and what those and whether those banks are how much those banks are financing fossil fuels. And yeah, so there's lots of different surveys and reports that Share Action puts out. It feels like it's every second week that we're putting something out. But they tend to be quite thematic and targeted in terms of what they're trying to focus on. And a lot of it is trying to engage with specific types of actors, be they banks, be they firms, be they asset managers.
Are there any other questions from people? Marky?
I think you covered this in the talk, but I just wanted to double check. We were talking about the PRI, it's I can't remember what it stands for, but it's
Principles for Responsible Investment. Yeah.
Did you say, is there a group that, if like all these companies are signed up to it, is there an organizational group that holds them accountable to the principles, or you did say there were like some holders on? Is it more just a lip service thing, but there's no repercussion or follow-up? Or
I think in the past it was more like that, and PRI did a lot of soul searching around their 10-year anniversary, so going back 4 years now. And what they've done now is become much more coercive in terms of what they expect their signatories to do. So I think to be fair to them, the initial phase was really about getting everyone on board. So get everyone to recognize that this is something that's important. And for those who are really keen, that they can actually use this umbrella organization to actually then mobilize against firms. But in the last 4 years, as an organization, they've said, okay, there's so many investors, so many members now that are doing nothing. They sign a piece of paper, they pay us a couple of grand a year, and then they say that they're part of us, but actually they're not really part of us. So they've been doing their own rankings, which I do not think are public. But if you fall below a certain letter grade, then basically you're on notice, and then you can potentially get kicked out. They have quite a big infrastructure now. So if I'm not mistaken, it's about 100 people working for PRI. And they're part of that is to try to coordinate just that massive investors, but also to try to encourage them and educate them, and try to share information between the members.
I wanted to ask for some clarity about when you were talking about company execs who are related to different companies. Mm-hmm. What did you mean by related? Did you mean that they had previously worked in those companies, or that they held shares in them? Or
actually, if you look at so I'll just bring it back to that picture.
Mm-hmm.
So in terms of Exxon, Lee Raymond is the CEO and chair of Exxon. So it's a current employee. I think all the companies here that are represented, the only ones that are not current is the guy from Boeing for JP Morgan, but he literally stopped being, I think he was the COO, but he literally stopped being the COO like 2 years ago or a year ago. And then I think it's the guy from Cisco is, it's the guy from Aviva is the former CEO of Aviva's investment business. But again, he literally stepped down from that a year ago. So these are still people with very strong connections to these firms. Everyone else, as far as I recall, is actually a current employee of these other firms. And you find this across most firms, that they'll have other CEOs, other CFOs, and the like, other company CEOs and CFOs on their boards. And this has been a big topic of research for many other topics as well, less so in terms of sustainability, and definitely not many people have looked at the asset managers themselves and the potential conflicts there.
What impact do you think, I mean, you talked about the impact of the conflict of interest in terms of pressuring different companies by the asset managers, but do you think there are other impacts of the conflict of interest? And also, second question, how could is it something that we want to prevent, and if so, any ideas? How?
Yeah, sure. I think the second answer is probably easier for me to answer. The second question is easier for me to answer in that if you look across other models of governance, so for example, in Germany, you have these workers' boards as well, where you have employees that are on the board of directors. One thing that I find just crazy is that there is no voice on these boards for civil society, for employees, for basically anyone who's not in that in the set of corporate interests, essentially. And okay, you can argue these are for-profit firms, all that sort of thing. That's what they're focused on. But I think that there is work showing that diversity on boards, both in terms of demographics, but also in terms of ways of thinking, actually makes for more effective boards. And so by extension, then adding those from other sectors, I think would be a very positive thing. In terms of other conflicts of interest that go on here, I haven't thought too much beyond the direct line of sight there, in terms of lack of engagement or lack of voting. But I imagine that there's also some pressure. Not only is there lack of pressure from the asset manager to these companies, I imagine there's pressure on the way back in terms of, well, this is what we think you shouldn't be saying or should be saying, or this is a way to frame an argument which suits our company and maybe makes it harder for our competitors. So for example, this is all hypothetical, but Exxon, I find it really annoying actually. I've been listening to these NPR podcasts here in the US, and you get these ads on Exxon's investing in renewables, where we're looking at algae as a potential source of renewable energy. And when you look at what they're actually doing, it's like less than 1% of their energy mix is renewables. But I can imagine that Exxon is saying to Jamie Dimon, the CEO of JP Morgan, let's focus, why don't you talk about algae as a potential source of renewables, because Chevron, one of our competitors, isn't doing that. And so you can say they're bad, but Exxon's good. So it's that sort of influence which we can't see, that is concerning. But I think the bigger issue, as big an issue, is that there's just a lack of representation of other stakeholders there.
Stay safe, stay busy, and tell us a cool story next time we see you.